In this video, I'll be talking about the basics of when traders buy and sell a stock for profit in the short term. I'll be going over trends and moving averages, which form the fundamentals of technical analysis. Now, if you are more interested in how to select a good company to invest in for the long term, check out my other video linked in the corner above. Hello everyone, my name is Hank, and on this channel we'll be talking about money and personal finance. So if these are topics that might interest you, be sure to subscribe to the channel. Now let's get into it. While it is absolutely true that you should not try to time the market, having an understanding of the trend of the stock and when it might be overbought or oversold can help you avoid the uncomfortable feeling that when you buy an investment and suddenly it just takes a nosedive and you lose tons of money. We'll start by talking about different types of trends. There are three main types of trends when it comes to stock price movement. There is the uptrend, where the price goes upwards, and there is the downtrend, where the price goes down, and there's also a sideways trend where the price bounces up and down within a range. Let's now have a look at an example on the stock chart. An uptrend is considered as a series of higher highs and higher lows. So in this example here, we have highs here, we have highs here, we have highs here, and we have highs here. So this is a series of higher highs. So let's look at the lows here. So we have lows around here, lows around here, lows around here, lows around here. And we have a series of higher lows. So this example is considered as an uptrend. On the other hand, a downtrend is considered as a series of lower highs and lower lows. So here we have highs here, have highs here, have highs here, and highs here. So we have a series of lower highs. And if we look at the lows, we have lows here, lows here, lows here. And we have a series of lower lows. We can now draw trend lines by connecting the highs, also known as the peaks, and also by connecting the lows, which are also known as the troughs. The more points the trend line passes through, the stronger the confirmation for the trend. So I can connect the highs here to form a trend line, and I can connect the lows here to form a trend line for the lows. Now, drawing trend line is a bit of an inexact science, so there's a bit of estimation involved. The trend lines through the peaks and troughs form a channel of prices to show the support and resistance area. In this example, the bottom line is known as the support and the upper line is known as the resistance. The support means that it's a price where people think it's worth buying the stock, and the resistance is a price where people think it's worth selling the stock to take profit. For technical traders, the trend line can work as both support and resistance. Before the price has broken below the bottom trend line, it is acting as support. Now, after the price has gone below the bottom trend line, people start selling the stock. So now this bottom trend line becomes the new resistance. How do we use trend lines to determine when to buy and sell a stock? So if you have identified an uptrend, You can use that to your advantage by buying near the support level and selling near the resistance level for profit. So this is a chart of AMD from a few months ago. So one possible strategy is to buy around the bottom support level and sell around the resistance level. So in this example, this particular stock has formed a really nice uptrend, and there's quite a few different places that you could buy and sell for profit. Now let's go and have a look at another fundamental aspect of technical trading, the moving averages. Moving average is one of the most popular indicators used in technical analysis. It serves to average out the price over a particular period of time. The most basic example is the simple moving average, or usually just referred to as the moving average. It is calculated by adding up all the prices over a period of time and dividing by the number of points in that time period. So here I have the stock chart for Apple, and I have the 50-day moving average plotted here. So the price here at the end is the average of all 50 prices beforehand. Moving average is often used by traders to identify price trends. When the moving average line slopes upward, it is considered as in an uptrend. And when it slopes downwards, it is considered as a downtrend. Traders also quite often use the moving average as support and resistance levels, much like they do with the trend lines. There are many different moving averages that traders use. Commonly used moving averages include the 20-day moving average for short-term trends, and the 50-day and 200-day for medium and long-term trends. It is considered a lagging indicator because it follows past trends. So now I have plotted the 20-day moving average as the pink line and the 50-day moving average as the purple line and the 200-day moving average as the black line. Now, it's useful to think of the price around the moving average as a rubber band. So when the price of a stock is far above the short-term moving average, it is considered overextended over the short term, and there will be a strong selling pressure for people to take profits. For example, here, the current price of the Apple stock is quite a bit above its 20-day moving average. So there's quite a strong selling pressure for people to take profits. Let's now have a look at the stock chart for Netflix. So if the price of a stock is far below its short-term moving average, such as around here, there will be a very strong buying pressure because people will think that the stock is underpriced in the short term. Therefore, in order to use moving average, you can identify a stock that is priced far below its moving average, and it may be worth picking up that particular stock in the short term. So in this situation, the price of the Netflix stock has snapped back after dropping much below its 20-day moving average. Now, always remember that short-term trades carry high risks, so do not invest what you cannot afford to lose. If you are interested in trading company stocks, be sure to check out my reviews on different trading platforms available in New Zealand.